Now we're going to look at how we prepare for financial statements by using the worksheet. If you are a business student and taking accounting as part of a business program, you're not likely going to be tested on this. You'll be tested on creating the adjusting entries in the journal. But if you are an accountant, you must learn how to work with a worksheet, which is a tool that accountants use to summarize all the data to see if the income statement and balance sheet will work out correctly. And so we begin, and the best thing to do is use the slides from the Kimmel and Kiesel accounting textbook. So the balance sheet, the trial balance is the first thing. We list the accounts in the order that they are in the ledger, and we make sure that we have equal debits and equal credits. The next thing is to create the adjusting entries. And as you can see, we made some adjusting entries. We debited supplies expense, $1,500, and credit supplies. That is, we recognize the expense and reduce the asset. We had insurance expense and reduce the asset, prepaid insurance. If we had prepaid rent and we used up that, it would be rent expense, debit, and credit prepaid insurance. We also looked at how we record depreciation and the accumulated depreciation. Our old friend unearned service revenue, and we recognize revenue. Then the accrued revenue, we have accounts receivable of $200, service revenue of $200, accrued expenses, interest expense, and salary expense. So those are adjusting entries. Now, before we post them to the general ledger, we test them and see if everything's going to be in balance, and that's the purpose of the worksheet. So here we enter each one of those transactions. For example, the first transaction was a debit to supply expense, and that would be down here, A, $1,500, that should be A, and a credit to supplies, $1,500. The second one was a debit to insurance expense, $50, and a credit to prepaid insurance. And so we simply put them in the debit and credit columns. Here we have a debit to unearned service revenue because revenue went down, and a credit to service revenue. Also the accrued revenue, debit to accounts receivable, and credit revenue earned. Same with salaries payable. We had salaries expense. We did the $1,200 there, and salaries payable. So we totaled then all the debits, $3,440, and all the credits, $3,440. Now, our trial balance balanced, our adjustments balanced. Now we put the two together. Now it doesn't mean that we add 344 to the 2,800. No, we simply put them together. Cash was a debit balance in the trial balance, no adjustments, so it's a debit in the adjusted trial balance. Supplies was $2,500 in the trial balance. There's a $1,500 credit against that, therefore they would have a debit balance of $1,000. Prepaid insurance was $600 debit balance. We have a credit against that, therefore it would have a debit balance of $550, sorry. Nothing on equipment, nothing on notes payable, accounts payable. Unearned service revenue, now watch that, it had a credit balance of $1,200. We have a debit against that. We reduce that liability. The liability now is $800. And so on. And the adjusting entries have created some new expenses down here. For example, depreciation expense and interest expense, and also interest payable and salaries payable. So we add these two together. We add up the debits again, $30,190. We add up the credits and we make sure they balance. Now, we sort the accounts into the income statement and balance sheet. We start with the income statement. Well, first of all, service revenue was a credit here, would go over as a credit in the income statement. All these expenses are debits in the adjusted trial balance. They will be debit on the income statement. So supplies expense would be a debit in the adjusted trial balance. It would be a debit on the income statement. And that's what we do. We sort the accounts that belong to the income statement into the income statement columns. And the result is we have a credit, which is the revenue, $10,600. And we have salary expense, rent expense, supplies expense, insurance expense, depreciation expense, and interest expense. So now we total the columns, and we have $10,600 in credits, but only $7,740 in debits. So we don't balance, but of course we wouldn't balance, because the credit represents revenue and the debits represent expenses, and we would hope that the revenue would exceed the expenses. So we would expect the credits to exceed the debits. Now, we then sort the rest into the balance sheet. The cash goes into the debit of the balance sheet. Supplies, $1,000. We just go back here to the adjusted trial balance and we carry this total over here into the debit columns. Now, these won't balance because what we had is retained earnings up here of common stock retained earnings of 0. There was nothing in it. But now we know that the net income, which is the difference between revenue and expenses, should be added to the retained earnings. So we sort the balance sheet accounts. And once we sort them, cash in the debit side, prepaid insurance, what have you, the liabilities, notes payable, accounts payable. We have salaries payable down here too. That's a liability that was created, as well as interest payable. And we have accumulated depreciation, which belongs on the balance sheet, and accounts receivable, which was created by one of the adjusting entries, and so on. When we total the debit side of the balance sheet accounts, we have $22,450, and the credit side is $19,590. So you see the difference between this and this. If it's exactly equal to this and this, we know that once we determine our income our profit and add it to the retained earnings, then the balance sheet would balance. And that's what the next slide will show. And here we have it. The difference in the income statement between the revenue accounts of $10,600 and the expense accounts, $7,740, is $2,860. And the difference over here, the debits exceed the credits by exactly the same amount, $2,860. So you see, when we add this $2,860, the retained earnings, then this side, the credit side of the balance sheet, will go up to $22,450, which will equal the assets. And therefore, in this case, we know that the debits equal the credits, that everything is in balance, and we have not made any kind of major errors or any type of errors. We can now proceed to do a formal income statement, revenue minus expenses, a statement of retained earnings, as we did in week 1, and a classified balance sheet with these account numbers here. And in that way, the accountant is able to ensure that the preparation of financial statements is correct and complete. Now, once that happens, the next step would be to close the accounts, and that would be the next video.